Hi, in this video, we will explore medium to long duration funds. First, let us understand how debt funds are classified. Debt funds are usually classified based on the maturity tenure of the underlying instruments. Based on this, there are various categories such as liquid funds, low duration funds, long duration funds, and so on. The instruments the fund manager chooses to invest in depends on the tenure of the fund. Long-term debt funds have a higher exposure in government securities and corporate bonds, whereas shorter-term debt funds invest more in money market instruments and treasury bills. Medium to long duration funds invest in debt securities such as bonds and government securities with a Macaulay duration between 4 and 7 years. Macaulay duration is the weighted average time period of the cash flows from a bond investment. To put it simply, it is the time taken for an investor to get back his money invested in a bond. Medium to long duration funds usually have a mixture of corporate debt, government securities, and money market instruments in their asset under management. According to SEBI, this fund is an open-ended debt scheme investing in debt and money market instruments with a duration between 4 and 7 years. The higher the Macaulay duration of a fund, the riskier it gets. This is because in a longer tenure, debt funds are much more prone to interest rate changes. This causes investments to be much more volatile. Since these funds are of a shorter tenure than long duration funds, they are less risky. This fund is taxed the same way other debt funds are. A holding period greater than 3 years is subject to long-term capital gains tax of 20% after indexation benefit, whereas a holding period of less than 3 years is subject to short-term capital gains tax. On average, the returns from these funds are between 8 to 9% yearly. This fund is good for investors who want to park their money in a long-term fund, which offers the benefit of higher returns than a FD and is also less risky. Before investing, it is important to do a bit of research. This is because these funds have exposure to corporate debt, so they do come with a credit default risk. Thank you for watching the video.